Today we are looking at DraftKings Inc. ticker symbol DKNG. Is the stock a buy or sell in 2022? The current share price is $12.52 a share, down from its all-time highs of around $72. That is almost a 83% decrease. It is back to its pre-pandemic levels. Is this the right time to buy? This is a stock that's held in Cathie Wood's ARK Innovation ETF, which is ARK. You can see here DraftKings is the 17th largest position with a value of $215 million. What we're going to be doing to see if the stock is a buy or a sell is looking at my discounted free cash flow model and my Buffett-Graham intrinsic value models. This will give a fair value of the stock based on its most recent earnings and financial information. Is this a buy or a sell? If you want to use the sheet if you want to download the sheet that I use in my videos, please go to my Patreon. Link is in the description. So what is currently happened, as I said before, it's $12.50 a share and down from its all-time highs. What we do here is we go to my tracker spreadsheet, we look for our DraftKings and we add the numbers in. If we go to Yahoo Finance, which is here, we want to go to the financials. Oh crap, I clicked on the wrong link. Damn you adverts. We go to the financials here and we first look at the income statement, which is the revenue. So revenue for DraftKings is increasing 226,323,614. 1.3 billion at the end of the previous year, and the trailing 12 months is 1.4 billion. So we're going to take the last 4 years here and paste them into the sheet. Next, what we're doing is looking at the profit. Profit is the net income available to common stockholders, which is here. Not a profitable company, and in fact, it is decreasing, minus 1.6 billion in the trailing 12 months. And this is steadily increasing. So not what we like to see. We want to see that the stock is profitable, but this is a bit of a gamble. So let's paste those values in there. Next, we want to be looking at the shares outstanding. Are DraftKings buying back their shares or issuing more shares? You can see here they are issuing more shares. In fact, they've over doubled, 184 million to 402. Now, is this a bad thing? Not necessarily, because as I showed you in the start of the video, the share price was massive compared to this. So they were issuing shares when it was $30, $40, $50, $60, potentially even $70, and now it's at $12 a share. So if they're using that capital to reinvest in the company, it is not a bad idea that they have done that. So let's just copy these in, 402. Which is the most recent number. Oh, in fact, I already have them in here. And 184. Finally, we want to look at the free cash flow. Yahoo Finance is nice for us. They do calculate the free cash flow, so we don't have to. What is free cash flow? Cash operations minus CapEx. And you can see operating cash flow is negative and once again decreasing massively. CapEx has increased, but nothing dramatic. 42 million, 47, 98, 108. But free cash flow is in the negatives and once again increasing. So let's put these numbers into our sheet. And next thing, what we want to do is calculate the average free cash flow, which is once again negative. I would say the average free cash flow isn't too good here because it is decreasing. We want to make sure that we look at that in the estimations. Now we want to look at the analyst estimates. We go to Analysts and it will give us the estimates on the high and low side for the current and next year. 2.1 billion, 2.81. We're going to take the averages rather than the high or the low. So let's add these into our sheets, or if you've already seen, they have already been added. 2.1 billion, 2.8. We want to get the WACC, weighted average cost of capital. We can calculate this or just go to this website that calculates this for us. We'll look at the mid, which is 9.3%. Once again, there it is. And if we go back to the analyst screen of Yahoo Finance, we want to look at the growth rate of the company, minus 6.8%. Now, next year is 37. I normally take the 5 years, so we're going to put in minus 6.8, but we're also going to remember the 37% is and look at those estimates there. So we've added everything in. Now we go to our value sheet. Let's add in DraftKings, DKNG, and let's take the averages of all the numbers, because we're going to look at the averages and we're going to tweak these slightly to make them a bit more usable. So, and minus 419. So I will tell you right now, this is going to give us a wildly negative value. Yes, it does. You can see it gives a fair value of minus $110 a share. this is with continuing decreasing free cash flow. So if DraftKings keeps on doing this, then the stock is probably going to go to zero, which is what this is showing. But what we're going to do is tweak the numbers, have a look at them, and see what we can do here. So the free cash flow rate is positive and increasing. So we're going to look at that. The revenue growth rate is increasing 47%, 52 with 7 in 2020 in the end of the current year, but analysts are expecting about 30% growth and then 25. So let's go somewhere in the middle there. Net income margins, once again, it's a negative, unprofitable company, so that is not something to look at, but the values are negative. So to get it to $12 a share, what would this company have to be making in terms of that? So let's just change the net margins to a more filling amount. Microsoft is about 38%. So this is a software company at its whole. I mean, it's a gambling company which should have quite high net income margins because it's selling more of a service. This would have the stock quite dramatically at $30 a share. So it doesn't have to do that much in terms of increasing of free cash flow for it to be a pretty good purchase here. 300 million, 500 million. This is less than $1 billion in 2026. So let's just say that's a little bit high. Let's go down to 20%. Stock, once again, $18 a share, 10%. Even when it's at about 100 million and next year, 150, 200, and 266, it is still only about fairly valued. Let's try and get it exactly to get in a number here. So about 14%, well, 13.5. That is saying it's slightly undervalued in a minute. It doesn't have to have necessarily that much free cash flow for this to be a fair value. The company needs to turn itself around pretty quickly, but if it does, I think it could be a buy, but its current state, not so much. Above a gram intrinsic value, I'm going to tell you right now, this will not like the stock. No, it doesn't. Why is this? Because the earnings per share is negative, and the expected growth rate, that is not 20%. What we want to do is change it to that cell there, because I've added that in the other day to do some testing. This is gonna, well, it's a negative and a negative, so it's a positive. So ignore this right now. That isn't correct. Earnings per share, say it was $1, it would be negative. So it would need to have about 37% growth, as it said, over the next year. And if it was $1 a share, that would be massive, but it would be a lot less than that. To get it about fairly valued, it would have to have an earnings per share of about 1.2 with the expected growth rate in the future. But analysts are not thinking that. They're thinking it's going to be a lot worse. So above a gram intrinsic value, I would say stay away. So both models say at the current place, the stock is not a buy. I would recommend that as well. I don't think the stock is a buy, but you can see from the discount free cash flow, if it turns around quickly, starts generating positive free cash flow, this stock, because of its current price and market cap, could be a pretty good buy. But as it currently is, it is not. Right, guys, thanks for watching. Please give a like on the video if you enjoyed it. I'm also working on some software as well. I'm going to try and automate this sheet and get rid of all of the manual processes that we have to do, which is basically going to Yahoo Finance and getting the data. I can automate it through the sheet, but I am also trying to make some software which will do everything for you, connecting to a stock API, which gets all of the financial data and then calculating the discounted free cash flow and buffer gram intrinsic values in a nice, pretty website. So that's something I'm going to be working on the back end, but in the short term, I'm going to try and improve this sheet. Right, guys, thanks for watching. Please give a like on the video if you enjoyed it, and I'll catch you guys next time.